You've rarely had this type of exuberance in the market. You've rarely had this type of household allocation to equity levels, which is at a record, by the way. You've rarely had professional investor allocations to equities, which are also at a record. And you've never had just overall, just consumer confidence about the market is at an all-time record.
Right.
You've
And by the way,
never,
too, one more thing to put on that on the worries is you've never had so much of the senior population be this exposed to equities either.
that's right. And so but historically, whenever you've had the combination of those events, that has typically been the peak of a market cycle, not the beginning of one.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of another week, at the end of another year, to do a weekly market recap with my good friend, the retrospective Lance Roberts. Lance, how you doing?
I'm doing well. How was your Christmas?
My Christmas was great.
Awesome.
For those perceptive viewers, you might see I look a little green around the gills. I came down with something last night I don't wish on any of you. And it's one of two things, maybe even both. My brother-in-law, who we spent Christmas Eve and Christmas with, has younger kids. They all got the violent vomiting disease after we hung out with them. So I either picked up that bug from them, or last night we were having dinner with some friends. And Lance, I think you're familiar with the podcast on YouTube called Hot Ones,
Yes.
where they did, for those not familiar with it, it's an interview series with celebrities, and the interviewer has these bottles of hot sauce, 10 bottles of hot sauce that go up in severity to insane levels. And apparently you can order a kit from Hot Ones of the chili sauces that they use. And they had done a party, I don't know, a month or so ago, and they were telling me how, fun it was. And so, of course, the bravado kicked in, and I said, well, how hot's the hottest one? And so they brought it out, and I had it. And, it was super hot. I mean, it was just like eating battery acid. And I actually felt pretty proud of how I handled it in the moment. I thought like, this is pretty bad, but I think I soldiered through this. I think maybe I'd be pretty good at this competition. And then, of course, I woke up in the middle of the night and it felt like my intestines had been napalmed. So it's one or two of those things, but it's been, I think I've dropped like 5 or 6 pounds already just in the past 10 hours. So anyways, enough about that. I hope your Christmas was great, Lance.
It was great. Kids all came in from college, so we've just been spending time together, having some nice family time, and so we went out to eat last night. Went to Mexican food, lots of really greasy enchiladas, and I'm just joking.
I was gonna say, you're trying to make me even more queasy. Yeah.
Yeah, I'm
Well,
just teasing. But no, it's been great, and I appreciate it very much. And I hope everybody watching had an absolutely wonderful and Merry Christmas. And now we're getting ready for New Year's.
exactly. And for a whole brand new year. So let's do a little retrospective look a bit in this podcast, and then if I don't have stamina this time, and folks, this will probably be a shorter one than normal. If we don't get to it this time, next time we'll really get into the look ahead for 2025. All right, Lance. Well, look, why don't we start with the meat of the sandwich here? Uh, Maybe we might want to pull up the S&P if you've got that handy. But our past couple of videos over the past few weeks has been Santa Claus. Will he or won't he? It's going to be Santa Claus rally or Grinch bust this year. And as of yesterday, it looked like Santa was arriving, right? The S&P 6100. Morning, we're talking here early in the trading day. S&P is down over 1%. I think we're back under 6,000 on the S&P. Now, this is probably just chop, but are you seeing anything in the action here that makes you either change your opinion on the timing of the Santa Claus rally, or is this just kind of regular
It,
par for the course, end of your chop?
I mean, we had two really good days back to back, and we were trading below the 50-day moving average, and we rallied back above both the 50 and the 20. And so, we had two really good days of rally. Not surprising to see a little bit of a pullback here. Again, there's nobody around right now. Everybody's on vacation. So Monday, Tuesday, when kind of people get back into the office and kind of really start trading, we still have window dressing to do on Monday and Tuesday. Markets are closed on Wednesday for New Year's, and then on Thursday the markets open back up again, and so we'll see the finishing of kind of positioning for the new year, and the Thursday and Friday. So again, I mean, look, I mean, there's never a guarantee, and I wrote an article about this just a couple of weeks ago talking about the Santa Claus rally, is that 76% of the time the market rallies in the last 5 days and first 2 days of January. But there's 24% of the time it doesn't. So, we've had a phenomenal trading year this year. The markets are up 26, 27%, not including dividends this year so far. And so kind of some end of the year positioning here is not surprising. I mean, we're seeing kind of assets, get sold off in certain areas on tax loss selling that had underperformed this year. We're seeing, other positions that have done really, really well. They are getting sold off on capital gains, getting sold for taking in capital gains. So, we're just seeing a lot of that repositioning of portfolios. Pension funds have $21 billion to liquidate today. So again, that's some of this early pressure in the market. I think by the end of the day, we could very well see this market rally back. Some I don't think we'll get back to even today, but you never know. And then I think potentially we see a little bit more of a rally, into next week.
All right, Lance, is there what level, if stocks sunk to or maybe failed to rise to from here, would make you think, oh, maybe this doesn't bode well for the start of 2025?
Well, so we're about to get into a whole bunch of Wall Street axioms, right? So Santa Claus rally. If Santa Claus fails to visit Broad and Wall, that doesn't bode well for the year. The first 5 days of January typically kind of set the tone for the year, and then the month of January sets the tone for the year. So you have the first 5 days, so goes the first 5 days, so goes the month, so goes the month of January, so goes the year. Those are the Wall Street axioms that really kind of lay out, generally, statistically speaking. Again, these are averages. It doesn't mean every year works out that way. Just always got to keep that in mind. There's, 70, 80% of the time in a lot of these cases, if these kind of short-term periods come to fruition, the market tends to either do well or poorly for the year. But look, I think going into next year, I think we've got to be a little bit cognizant of the fact that exuberance is very high in the markets. I mean, Wall Street analysts are very optimistic about next year. Earnings expectations are well above long-term trends for next year. So, and again, you've got a new administration coming in that's proposing a lot of changes. We don't know how those changes are going to actually impact the economy. Of course, a lot of people are concerned about, tariffs are going to bring back inflation. There's not really any evidence of that, but, hey, that's a fear. On the other side of it, we're talking about potentially cutting spending, which has a big impact on corporate profits. We just wrote the article recently on the Kaliki profit equation, talking specifically about how that could be an issue. Corporate profits are at record highs right now. So there's certainly some things going into next year that could certainly undermine some of this more bullish outlook. Again, there's just a whole variety of other things that can come along from, Fed policy to monetary policy to a variety of other things that could really kind of undermine that more bullish outlook. So I think we've got to be somewhat cautious. We've had 2 years of greater than 20% returns. That's fantastic. Normally, if you had 2 years of 20% returns, the third year tends to be positive, not as much, but tends to be positive just because of momentum. But there's, we haven't had these types of returns since like 1929. So then there's that, right? So. Right. I think you just got to, it's no reason to be bearish. Everything underpinning the market right now is very solid. There's nothing to really be overly concerned about. Credit spreads are low. We've talked about that before.
I was just about to ask about that. Yep.
Those haven't changed. So, but I do think we need to be as managers of capital, I think we need to go into next year with, just a little bit of a kind of an erring to the side of caution. Now, that doesn't mean, being a bunch of cash, just kind of keeping an eye on the risk and just kind of tempering our expectations a bit that maybe next year is a 5 or a 10% return year, and somewhere in the middle of the year, there's a 10 or a 20% drawdown. Entirely possible. We saw that back in 2022. had a 20% correction, the market rallied in the end of the year. So, those things can happen. And I think we just need to be aware of that.
Okay. Yeah, I would say I wouldn't necessarily call it a parade of horribles, but I would say there's a parade of concerns heading into this year. And you mentioned a bunch of them, and I got a few more I want to ask you about.
Sure.
That you know advise caution. Again, not panic, not get out of the market, but just like, you know, expect a year that's not as good as the past two that we've had. If we did, I don't know if you have the data set, in your brain here, but if we did have another 20+% year this year, 3 years in a row, how statistically rare would that be?
Not too, it's not out of the ballpark rare. I mean, it's happened in the past. I mean, it's not something that happens.
But like a 5% probability or 20, a quarter of
No,
the time you get it,
it's
right?
probably, to have 2 years of 20% up and then another year, I think it's happened 12% of the time, give or
Okay.
take. Don't quote me
Okay.
on the numbers, but it's somewhere around that. I mean, it's not statistically a very high probability. It's kind of another massive return year, but it does happen.
Okay. But it's the kind of thing that you don't want to be counting on by default if 9 times out of 10 it's not in your
Yeah.
favor.
No, and I think that's the big risk here for a lot of investors is, look, over the last 14 years, 2010 to present, we've had abnormally high returns in the markets, running 15, 16% a year on average. And I think investors have gotten very complacent, expecting these very high levels of return. And but we forget that that's been a function of zero interest rates, massive monetary interventions, QE, a whole variety of other supports, about $47 trillion worth going, over time. And and I think kind of depending on those kind of elevated rates of return, when your long term average is 8, and you're getting basically double that over the last 10 years, I think investors are getting very complacent that these high rates of return are now just normal. And and I think if you get a year next year where it's more volatile and you get a 5% return year, people are going to go, man, this sucks, right? It's just this is terrible, right? We're in a bear market, obviously, and you still make 5%, but that would be more normal than repeated 20% years. And with interest rates up, with interest rates more elevated, the Fed's high, still has fairly high interest rates running above the rate of inflation right now. Monetary policy is being reversed. I mean, we're still doing QT. Interest rates are elevated, and we're seeing bank reserves decline. So money's being extracted from the system. So I think
Plus the corporate debt maturity wall, which will do the same thing, plus the Doge efforts, if they're successful, to reduce deficit spending. Like again, it's sort of this parade of concerns, right?
yeah. And so I think you just need to keep that in your hip pocket and just, don't go into next year being completely, just kind of blind to the risk and not really paying attention to how you're managing your money. And just, again, that doesn't mean go sell and raise a bunch of cash and
Right.
go be out of the market. I'm not saying that at all. Just, I think we're still maintaining full equity allocations right now. We're still running, in our 60/40 portfolio, we're still running 60% equity. And that's not going to change anytime soon, but we are watching it very cautiously.
Right.
And
And when and if you do start to ratchet that down, right, you start to take on more cash, obviously that's what these weekly videos are for. Please let us know so folks know that you're starting to get a little more
well,
cautious.
yeah. And look, and this is if you go to our Substack channel, we post a daily market commentary every day on Substack. We also post our weekly newsletter on Substack. So if you just follow me over there, I post when we do trades. I post them in the newsletter. At the bottom of the newsletter every week is our trades for the week. So if we start raising cash and selling stuff, it'll be in the newsletter. So if you're on Substack, you'll get the newsletter and you'll see the trades that we're doing. So even if I forget to mention it here, it's published. We publish
Okay.
everything we do. So
All right. Folks, just so you know, I'm not going to let him forget to mention it here. So if you're watching here, you will hear it here daily.
it's
Um,
just in case.
yeah. But again, just to put an underline under this, we have this parade of concerns. It's not a reason to get out of the market yet, but it is a reason to have some situational awareness, we'll say, going into 2025. And your point about euphoria, right? Regular viewers of this channel have seen me pull up the euphoria meter, which is basically at an all-time high, at least in the data set, which went back something like 35, 40 years, right? So you just
Yep.
have to be aware that you're coming into a richly valued market with all the potential issues that Lance talked about. It's going to be very hard to meet earnings expectations here. And I'm going to ask you about earnings in a second, Lance.
Sure.
It's going to be very hard to surprise investors to the upside because they're already pricing everything in per perfection. So you just have to be cognizant coming, and it's going to be very hard statistically to have a year like the past two that we've had. Like you said, maybe a 12% chance, right? So you just got to go in girding your expectations. Okay, it's probably not going to be a barn burner year. It's not time to get out of the market, at least not yet. But I shouldn't be expecting that it's going to be as easy pickings as it's been the past 2 years.
Yeah, and I know you just recently interviewed Ed Giardini the other day. Well, I had written an article. It was kind of interesting on the timing of your interview, but I'd written an article just recently talking about Ed Giardini and the problem of predictions. I wrote this back on November the 19th. And he wrote a rebuttal to that article. Apparently I offended him, which was not my goal, was not to offend him.
I was going to say, he noticed that your article, yeah.
Yeah, and that wasn't my goal at all. It's just I'll share a chart with you. But basically, what Ed was suggesting, and again, nothing wrong with this, but he's predicting that the market can reach 10,000 by the time we get to 2030, and just kind of running a trend channel that's about 7% a year. And again, that's fine if you want to make that prediction. There's nothing wrong with that, but there's a lot of risk that comes along with that over time. And again, we've seen these type of predictions before. And if we go back and, 2000, people were predicting, the S&P was going to go to 5,000. Then we had the dot-com bubble. In 2007, people were predicting again, hey, market's going to go to 5,000. Then you had the financial crash. And we've now had this exceptionally long run in the markets over the last really kind of 14 years, a very long period of just sustained bullish returns. And again, those sustained bullish returns well above long-term means. On a monthly basis, the market's extremely overbought on a monthly basis. Now, again, this is very long-term in nature. This is not saying anything about next year. Okay, so don't go, oh, Lance just said the market's going to crash. I'm not saying that at all. What I am saying is that when you've had these very long extended periods of the markets, that we become more liable or more vulnerable to some issue coming along that is going to kind of derail those more bullish expectations. And again, when we start looking at, for instance, how much this, so this is simply a chart of the S&P 500. This is the total return of the S&P 500 from 2007. So this doesn't start at the bottom of 2000. When you see a lot of charts, the market's up 500% since the financial crisis. So they picked the low point, 666. Right. And they're running from there. So I picked it 2007. Again, cherry picking start dates. You can pick any date you want. But the goal is just to show how much the market has grown versus cumulative real GDP growth versus sales growth. Now, I use sales growth, not earnings, because sales is what happens at the top line of the income statement. So I can't really fudge that much. I can fudge earnings down at the bottom through accounting gimmicks, share buybacks, all that kind of stuff. But sales are sales. And guess where sales come from? Sales come from economic activity. So people have to go out and buy stuff that creates the sales. Well, over that period, the market's up 302%. GDP, sales growth is only up 100%, and GDP growth is only up 40%, which is the sales growth and the GDP are disconnected to some degree now as well. But, it just goes to show kind of how deviated the market is price-wise, and this goes back to the core valuations and everything else, versus what is happening in the underlying economy. And again, this just makes us vulnerable, which was my point, to these kind of more ebullient predictions of markets going out for the next 10 years and not expecting some type of reasonable process that comes along, some event. And again, we don't know what the event will be. Nobody knows what this event will be. Nobody predicted, the financial crisis. Nobody predicted COVID. Nobody predicted the dot-com crash. Stuff happens. And these things tend to happen not when markets are undervalued, right? You don't have these events occur when the markets are selling at deep discounts. These things always occur when your markets are extremely overvalued, because it's not the event that causes the devaluation in the market. It's the event that changes the psychology of the market. And all of a sudden, everybody's got to reprice everything. That's what causes these crashes. Nobody expects those things. And so when you have companies trading at profits at a percentage of GDP at the highest level on record, going back to 1950, any change to corporate profitability that comes along, and it could be from any of these government incentives that we're trying to start, right? Cutting spending, again, clicky profit equation, you know, keeping interest rates elevated for too long eats into profitability. All those type of things can come along and reverse that profitability measure. If those profits decline, you've got to start repricing the market. This is where it becomes a lot more challenging. And you know, again, I wasn't trying to offend him at all. That wasn't my goal. My point is, and again, I lay this out. I say, look, the way to navigate that is to diversify across asset classes, maintain a balanced equity portfolio, use bond investments as a hedge, add exposure to alternative investments that have nothing to do with the markets, and keep cash reserves and stay flexible. And you know, the key line was simply, we nor anyone else know what the market's going to do in 5 months, much less 5 years from now. So these long-term predictions out into the wild are fine. There's nothing wrong with them. But if it and again, this has been my point about, you know, people predicting crashes. You know, hey, the market's going to crash by 50%. Okay, when's it going to happen? Because I need to know how to manage for that. Well, if I just tell people, hey, don't worry about it, just go buy an S&P index and hold it for 5 years, you're going to be fantastic, and then the market crashes 50% between now and then, what good have I done them? That doesn't do them any good. And the problem for people that don't manage money, which is always kind of my biggest pet peeve, it's great to make these long-term predictions if I'm just selling research, because I'm not liable for anything. Right? If my prediction's wrong, I just say, oh, well, you know, this, I didn't see that coming and this happened, and so now it's changed the dynamic. But, you know, when you're managing people's wealth and you're responsible for their livelihoods and their families', you know, security, you can't just make these willy-nilly predictions and not worry about potential consequences. And that's my whole point, is that, you know, we've got to manage for what we have, not just be ignorant of the potential risks that could come along.
Yeah, and I mentioned this a lot in this channel. No slam against Ed or any of the other very excellent analysts that appear on this program, but I always say I most prefer to interview capital managers, because you guys have your skin in the game. You have your reputation on the line because you have to manage client capital and be answerable to the performance. And so you just don't have the luxury, like you said, of giving an opinion. You really have to, it has to be calculated enough for you to put your own personal brand at risk.
Yeah.
That's why we have you on the channel every week, Lance.
Well, let's talk about earnings, because you brought that up, and I'm trying to spare you from having to talk too much. So
No, I appreciate that. Let me just mention one thing real quick, more of a chuckle, but I was being interviewed the other day, and they asking me, okay, what are you most confident about for next year? And, you know, what are your predictions for a black swan? And I said, you know, I think the biggest black swan I can think of is something takes down the market, right? We have some market correction, whatever the trigger is. And as you always say, that's going to be a black swan by definition. It's going to be the thing that we don't anticipate because it's not priced in. But I think the biggest black swan that would surprise the biggest amount of people would be, what if that happened and the central planners didn't step in to backstop it, especially during a Trump administration? I know right now that sounds like heresy, like people are just immediately, that could never happen. But of course, that's what you have to think about when you think about black swans.
You know, and it's an interesting point, because that was the point that Michael Pinto made when we were having our conversation.
That's right. That's right.
Yeah, he said that. He says, he thinks that in the next crash, right, the market's going to crash by 50%, and the Fed won't step in. And, you know, that's been a concern or that's been the question going back to 2010, really, because after QE1, even we were writing articles back then that, well, we did this, but don't expect the Fed to do this again.
Right.
And the next year, the market's down like 15%, and they step back in. And we said, well, don't expect them to do that again, because first of all, and I wrote a couple of articles, along the way talking about the efficacy of monetary interventions, and that it requires more and more monetary intervention every time you do it. And which has been the case. We've had to make these QE programs have grown each and every time in size to basically generate less effect. And so you're getting less return off each QE program than you got from the previous one. But nonetheless, every time we've had any type of concern in the markets. And again, you just go back to 2020 as an example. You know, supposedly the Fed's job is to protect the banks, right? So we know that. And the big banks, the major primary dealers, those are members of the Federal Reserve, and they benefit from the actions that the Federal Reserve takes. But their job is to basically ensure the banking system stays liable. Well, we started out back, remember, in post 2008, we bailed out the banks. But we didn't bail out anybody else. And so remember, that was why Goldman Sachs and Berkshire Hathaway and a bunch of other companies went and registered as a bank so they could get the bailout, right? Goldman Sachs started Marcus so they could do retail banking, which they've now sold off because that was a complete disaster on their side. But they did it so they could get that bailout, right, from the Fed. Well, then 2020 comes along, and we don't just bail out the banks. We bail out anybody that just claims they're having trouble. So, Boeing buys shares back for 5 years. They've got no cash on their balance sheet because they've been buying back all their shares. And they go, oh my gosh, we're going to go out of business. Well, we got to bail you out, because if Boeing goes out of business, the whole economy is going to go bankrupt. And we bailed out, Caribbean Cruise Lines or Royal Caribbean or Norway. I can't remember which one we bailed out. We bailed out a cruise line. But we started bailing out all these companies because we didn't want them to go bankrupt. And so to say that the Fed's not going to step in the next downturn, particularly if it threatens the financial institutions, I think is a stretch, because they've proven that every time you have a 15 to 20% drawdown, they're stepping into the markets. And I don't think
I agree. It's a total stretch. I'm not predicting it. I was just trying to think, what is the thing that would surprise the most people? And that's what I came up with.
No, I think I don't disagree with you. Yeah, I mean, if they don't step in, all of a sudden, I mean, the markets are dependent on it, right? The market's been dependent on what for the last couple of years. Even think about 2022, we started this correction. And all the way down that correction, we kept bouncing these massive bounces. And each one of those massive bounces was because, okay, the Fed's going to stop hiking rates, they're going to start cutting. And then the Fed said, well, no, we're not going to start cutting yet. And so the market would sell off, we'd go lower. And it's like, yeah, but they're going to start cutting now. Right. But the whole way down, we were expecting the Fed to start stepping in. And it's just a function that the Fed has trained the markets over the last, 15 years. And it's what investors expect. And I am sure that we get into the first, and again, don't forget, when you start talking about, the Fed not stepping in, it took barely a bank crisis of any sort. We had two banks go basically belly up, and the Fed stepped in with the bank term funding program, right?
BTFP.
BTFP. I always have to confuse it with BTFD.
Right. And the Silicon Valley Bank, or whatever it was, wasn't really even systemically critical, right? It just had a lot of connected venture capitalists who didn't want to lose their money.
Exactly. And that's my whole point. And they stepped in for that. So to say that the next time you have a pretty significant crisis, the Fed's not going to step in, I think it's a stretch, simply just because now it's a kind of a
it's a feature. It's not a bug. It's a feature of the system now. Yeah.
It's a great way to put it.
Totally agree. Again, the exercise was just, what are the things that we can try to, war game could catch us really by surprise.
Well, again, Adam, the problem is that anything you're thinking of, the market is already priced in. And that's the whole problem with it, right? You've got to get something that nobody's thinking about. And
right. Well, that's what I'm thinking. Just nobody's thinking about that one.
I don't know. If Michael Pinto's thinking about it, there's other people thinking about it, right? Yeah. And so the market's going, okay, well, if they don't step in, what I'm going to do? And then the market will position for that. It's just, again, you never know what it's going to be. It'll be the one thing, though, that nobody was expecting, and all of a sudden it changed. And this is all it has to do. I wasn't expecting that, and it changes the earnings dynamics. All of a sudden, companies aren't going to earn $251 a share next year. It's going to be $220 a share. Now I've got to reprice the market. That's all this comes down to.
Okay, so I've got two things I want to ask you about that. They're two questions, but to give me a break from talking here, I'm going to give them both to you, and you can figure out how you want to tackle them. Okay, first off, article from the Financial Times. U.S. companies are defaulting on junk loans at the fastest rate in 4 years. These are specifically leveraged loans. As they struggle to refinance a wave of cheap borrowing that followed the COVID pandemic, right? So this is Michael Howell's, again, renewed warning that, okay, we got this big corporate debt maturity wall. that's going to be increasingly rolling in 2025, and that is going to start acting like a liquidity sponge, right? That's also going to be increasing the interest service expense in the income statements of corporate America, meaning they're going to have less left over. It's going to hit earnings, to your point there, right? Okay, so let's combine that threat to earnings going forward to this tweet of yours, this recent tweet of yours. Okay, Lance Roberts, can someone provide a reason why non-tech earnings, and by non-tech, I'm sort of imagining the S&P 493. Can someone provide a reason why non-tech earnings will accelerate in 2025 when they haven't grown over the past 2 years with very strong economic growth? What dynamic is going to change that will spark an earnings surge with mega cap slowing that did not exist previously? I should note too that Ed Yardeni, while he thinks next year could get off to a sloppy start, he expects a bull market in earnings next year. So obviously he thinks there's some reason, but it seems like you're having trouble finding a good, a good indicator of this to hang your hat on.
Well, again, and nobody, and it was interesting too, because I got I got a bunch of comments coming back from it, a bunch of people email me stuff, but nobody could actually give me a reason. And analysts say, oh yeah, these earnings are going to pick up for these companies because of, deregulations and extension of tax cuts. Well, if I extend the tax cuts, I'm not changing the tax code. So that doesn't improve my earnings because taxes aren't changing. So I've got to get tax cuts pushed through, which would help. I've got to get a lot of deregulation done. That could certainly help, but these are marginal issues. If I go from 21% tax to 15, that's going to help, but it's marginal, right? It's not a massive boost to earnings.
It's not transformative, and it takes time to manifest.
And it takes time. And so, but just stepping back for a moment, we've had exceptionally strong earnings growth. Now, again, this just goes back to the basic premise of earnings and how they operate. So let's go back to what I said earlier. Where do earnings come from? They just don't magically grow on trees, right? They have to be generated from somewhere, excuse me. And earnings come from economic activity. Adam went out to dinner over the weekend and ate stuff he shouldn't have ate, and he spent money. I don't know exactly all your story, but you spent money in the system. So that money went to the restaurant. The restaurant uses it to pay salaries, to buy products, goods, and services that they need for the restaurant. That then goes out to all the other people that provide them those goods, services, and products. But that's the earnings. That's earnings for the restaurant. What the restaurant doesn't keep as a profit, they spend, and that spending goes to those other companies, which now generate sales. What they don't keep is profit that they're paying out their salaries and buying their products, goods, or services they need to run their business, so forth and so on. But that's where the earnings come from. It's sales. It's the raw sales at the top, less all my expensive, that generates earnings at the bottom. Now, here's the problem. Everybody's wildly expecting this strong earnings growth next year, but they don't really provide a reason why. They kind of stab at some ideas and they say, well, it'll be tax cuts, it'll be deregulations, things that we have really no idea that's going to happen. But what we do know as a fact is that over the last 2 years, we've had above average rates of economic growth going back to 2000. We've been running at 3% plus on a real basis, which is really good economic growth considering we're running at about 2%, kind of pre-2020. So we've had very strong economic growth, which means we had a lot of economic activity, and yet these companies, these bottom 490 companies, couldn't generate earnings growth. Earnings growth had been flat for the last 2 years. And here, I've actually had a tweet out this morning. Let me see if I can find it just real fast for you. I've actually posted a chart of this morning just to here it is. So this chart right here is U.S. tech stocks. This is 12-month earnings for U.S. tech stocks going back to 1990 in blue. And you can see that they're growing earnings phenomenally, right? So all this advertising, all these Instagram influencers, everybody that's making money off selling stuff online, they're doing great for these tech companies. But the bottom 490 stocks have had no earnings growth over the last 2 years. It's just been a flat line. It's not growing, but yet the economy is growing strongly. So now what you're telling me is that all of a sudden tech isn't going to grow anymore. But yet tech is the one that benefits from stronger economic growth. They'll benefit from deregulation. They'll benefit from all these other things. They'll benefit from the use of AI, which is going to increase productivity. But somehow their earnings aren't going to grow, actually decline next year. But yet everything else is going to, all of a sudden, everybody's going to go, okay, well, I'm not going to spend money on any of the major tech companies. I'm not going to buy Ozempic. I'm not going to do any meta ads on Facebook. I'm not going to do any Google searches, but I'm going to go buy all this other stuff from these other 490 companies. It just doesn't make a lot of sense. But importantly, let's take a look at earnings for a second and kind of where we are. So this is estimates going back previously. So the black line is actual earnings. And right now we've got actual earnings through quarter three. We don't have quarter four yet. We'll get those in January. So actual earnings for the S&P 500, according to S&P, this is from S&P, the people that run the S&P index, right? So this is their earnings, $200 a share. It was estimated in March of 2023 that by the end of 2024, we would be at $227 a share. In October of 2023, they had ratcheted down that to 224. We came in at 200. We were $24 lower in earnings than what the analysts were expecting going into the year. Now, where we
and by the way, markets didn't care, which just still blows my mind. But this is the whole, earnings season, every millennials earnings season, right? Everyone gets a trophy.
Exactly, but this is also why valuations are pushing 37 times earnings right now, because what happened over this last year was what's called valuation expansion. We expanded valuations on stocks even though the earnings didn't come in. We were all buying stocks on expectation that earnings were going to be 224 a share, that never came. So valuations went up, but earnings didn't.
Well, and just to be clear, you're really talking about multiple expansion, which valuations went up. They went up because multiples went up, not earnings.
Correct. Thank you for correcting me. You're absolutely right. But so where are we today? So this is my problem with these ideas that we're going to have this massive earnings growth in 2025, right? So right now, estimates as for quarter four 2025, and this was as of December, is at 251 a share. Now that horizontal black line that's dashed, that is the long-term trend line of earnings going back to 1957. That growth rate is about 7.7% annually. And what you'll notice is that while earnings can get above that, and that's not surprising, so in 2021 we had a big surge in earnings well above the growth trend because of all the stimulus. But as soon as that stimulus left the markets and basically we started kind of reversing back markets back to normal, earnings fell back below the trend line, but have now been traveling really kind of along that trend line ever since 2022. So what we're expecting for next year is that somehow magically we're going to have this massive growth in the economy next year that's going to allow earnings to grow well above the long-term trend. The only time historically that earnings grow well above the long-term trend is coming out of a recession. They go below the trend when you're basically in an economic slowdown or recession like we were in 2022. So the reality is that if in 2025, we should probably expect earnings to be closer to 220 a share than 251. And again, maybe it'll be 230 a share, something like that. But, I think expecting 251 a share next year is going to be well over the projection of what actually occurs. And, this kind of becomes the issue for looking at where markets are going to trade next year. So we can look at valuations and we can back into where we think year-end earnings will be. So let's just assume the 251 a share is right for a second. So at 29 times earnings, that would be a valuation, a multiple expansion. Again, we'll go from basically where we are now. This is, okay, so real quick, I know I just said 37, that's based on CAPE ratio. Looking at forward earnings estimates, which are operating earnings, doesn't include any of the bad stuff like expenses and running your business, but forward earnings, we're currently trading around 22 to 25 times earnings. So, if we look for a multiple expansion to kind of the 29 times earnings, you're looking at roughly about 7,200 on the index. Around 6,900 on the index gets you at 27 times earnings. That's where we've been trading for the last kind of few years. But anything below that, if you get any type of multiple contraction next year, slow earnings growth, something happens, we get to 25 times earnings or even 22 times earnings, which is kind of the long-term mean going back to 2000. You're talking about a fairly significant correction process. So you've got a reasonable upside next year, presuming that we can hit this 251 a share. Here's the problem. Let's assume I'm right for a second and that we don't hit 251 a share. Whoops. And we come in something closer to 220 a share. So if we come in at 220 a share, all of a sudden this becomes a lot more challenging. Let me see if I can fix this real quick. I don't know what happened. So if we just assume for a moment that maybe I'm close to being right, and that we kind of revert earnings by the end of next year back towards the long-term trend of 7% growth in earnings, which would be kind of normal. All of a sudden, these market outlooks change pretty dramatically. So if we have a multiple expansion, again, just kind of going back to this idea of 29 times earnings next year, which would be people just saying, I don't really care that earnings are $30 less than what I thought they were going to be. I'm still going to pay up for stocks. Well, all of a sudden now we're talking about 6,400 on the index. Now that's vastly different, 7,200 to 6,400. Every other measure at that point, if we come in at the long-term average of 27, any type of valuation contraction of 25 to 22 times earnings, which again, 22 times earnings is still expensive, and that's kind of a long-term norm going back to 2000, you're talking about a significant correction in the market. So, this is going to be the real challenge next year, is that a lot of these more optimistic expectations on earnings are based on hope more than anything else. There's really no factual underpinnings unless somehow magically you can create 4.5% to 5% economic growth next year, which I'm not saying is not possible, but we just haven't seen that like in 30 years. But, and that's real, that's inflation adjusted. So you've got to create real strong economic growth to try to justify that $251 a share, because anything less than that, we really start to run into trouble with valuations. And that's just because we've had such a big multiple expansion over the last 2 years.
Right. So we've had the big multiple expansion, which is why we've been talking a lot on this program of late of the record or near record levels of valuation extremes, right? We're just saying, hey, you just got to objectively look at this market and it is very richly priced, right? You've now said, look, it's really hard at this point to see us hitting 250 a share for the S&P for all the reasons that you just mentioned. On top of that, you then add Michael Howell's analysis about liquidity, right? Because it hasn't mattered that we've missed earnings quarter after quarter after quarter, earnings expectations quarter after quarter. Investors have been willing to ratchet up the multiple, right? And I think you can make an argument. I mean, it's a multifactorial thing, but I think you can make an argument. A really important contributor to that was that net capital flows have just remained positive, right? For all the reasons that they become positive, a not insubstantial one as well as the giant mindless robot of retirement fund purchasing month after month after month, right? And so if you have to have all that stuff continue to go right for the current projections to work out. And I think you're saying, look, you've already flagged a bunch of concerns that you think, it makes me think that's not going to happen. And then if you add Michael's thing in there about, by the end of the year, we've completed the cycle and it starts contracting. And we have the whole corporate debt refinancing wall in there that acts as an additional liquidity sponge. I mean, I almost think, to your question, the challenge is not what's going to drive these earnings higher. It's, hey, yeah, like convince me why they're not going to stay on the trend line.
Right.
Right. Yeah.
And that's kind of the point, is that, for the big bullish bulls, and again, there's absolutely no one that's pessimistic on Wall Street right now. If you take a look at 2025 estimates, they run from 6,600 to 7,000. So, there's not one single Wall Street analyst out right now going, I think next year is going to be a down year. And that's not surprising. I mean, but when you take a look at,
Because there almost never is. I'm trying to remember who I was seeing on this channel recently, but they showed back at the previous big corrections we had in the market, 2008, .com, whatever, right before the market started to tank, nobody had a negative
right.
prediction.
Yeah, no, and that's very true. And we're seeing that again here. And and again, like I said previously here with you, is that the one thing that has shocked me this year is how much money has flowed into the markets. We've had over $1 trillion of buying of ETFs. That's the most on record ever, and it's larger than the 800 million in ETFs that were bought in 2021 following when we gave everybody money to spend, right? I mean, we're sending checks to household and people were using it to go buy
Right.
Robinhood accounts and buy an ETF. And we're buying up leveraged ETFs, single stock leveraged ETFs. I mean, just the amount of speculation in the market has been absolutely phenomenal. Not even including foreign inflows of capital into the
I was
U.S.
going to mention that too, yeah. And sorry to interrupt, but also you can comment on breadth, right? Which is we have basically more foreigners in the U.S. market than ever before as a percent, right? We have more capital in the U.S. markets is concentrated into this Magnificent Seven,
Yep.
right? So it's kind of like the whole world is revolving around the single digit number of stocks, right?
Yeah, well, but again, think about it. If I'm a foreign investor, let's you and me pick up and let's move to France and buy us a little villa there, right? If we're living in France and we're going, well, our market sucks.
Right,
We're
right.
I got to make some money on my money. I got to put it in the U.S. because that's where. So it's just this. The U.S. has become this big Hoover vacuum cleaner of capital from around the world, and it's been phenomenal. It's been supportive of the markets. You know, Again, what changes that dynamic? I don't know. Could this market run to 10,000 by 2029 as Ed Giardini expects? Absolutely. But at some point, you almost have to just figure that something's going to happen. That's you've never had you rare I shouldn't say never because that's not true. You've rarely had this type of exuberance in the market. You've rarely had this type of household allocation to equity levels, which is at a record, by the way. You've rarely had professional investor allocations to equities, which are also at a record. And you've never had just overall, just consumer confidence about the market is at an all-time record.
All right.
You've
And by the
never
way, too, one more thing to put on that on the worries is you've never had so much of the senior population be this exposed to equities either.
That's right. And so but historically, whenever you've had the combination of those events, that has typically been the peak of a market cycle, not the beginning of one.
Yep.
And again, what changes that dynamic? Don't know. When will it occur? Have no idea. Could it last another 5 years? Absolutely. In 1995, everybody was calling a bubble in the market and it lasted 5 more years. So again, Ed could be absolutely right. We get to 10,000 and before this secular bull market is over. It could happen next year. I just don't know when, but that's why, I think we have to at least pay attention to the risk that we're taking in our portfolios and manage that somewhat accordingly.
Okay. All right, folks. Well, again, this is why I have Lance and the other financial advisors who appear on this channel with me week after week, so you can track their progress in real time as to how they're looking at the market and making allocation decisions. Because again, as Lance said, he just can't be slinging opinions. He has to be making allocation decisions based upon where he thinks the market is. So again, thanks, Lance, for providing that really valuable modeling for people so they can watch you and see what you do. I got one random question, and then we'll start beginning the wrap up because I'm amazed I've lasted this long. But there's definitely
Good for
my
you.
stomach is definitely telling me we don't have too much time left. Um, uh, so you had that chart up there of the I can't remember if it was the performance or the earnings growth of the tech sector versus the ex-tech sector, right? And the tech sector was basically shooting the moon, and the non-tech sector was pretty much tabletop flat over the past, decade-ish or so. Right? I'm
Right.
pulling it up now. Yeah, right there. Okay. And you said, look, and this is, the money's gone into the tech stocks because they very clearly have a very direct positive correlation with economic growth and stimulus and all the things that are being done to try to help companies. They benefit disproportionately from it.
Mhm.
My question is more of a Wall Street versus Main Street question. You were saying earlier about how during COVID, the Fed was there giving backstop loans to all sorts of corporations, right? And it
Yep.
really was picking winners and losers, right? There were a lot of companies, a lot of public companies that didn't get bailouts, right? So the Fed was selectively picking winners and losers. But I don't think any Main Street companies got that. I mean, there were PPP loans, yes, and that was a whole cluster in itself, but they got nowhere near the monies
Right.
that the big corporate companies did. And I guess my question is uh, anybody that lives in a relatively small town, and I live in one, we saw the decimation of a lot of local businesses during COVID because they were forced to shut down, and they couldn't operate, right? And a lot of them never recovered. The momentum, capital, benefits, whatever, is still way behind these big tech companies, certainly the e-commerce ones. People have really, I mean, we all got trained during COVID to order off Amazon and, press the easy button when you wanted. And these companies have continued to innovate, and drone delivery is now a thing, and it's the easy way to buy something. You probably can find the cheapest price and get it to you the fastest right now through some of these big companies. Is Main Street commerce pretty much just a dead man walking at this point in time?
It is if we continue. Yes and no, right? There's certain things that are always going to do well on kind of your Main Street town, right? I mean,
Bakery, you're not going to get your drone delivered. Maybe you will, I don't know.
yeah, but
Oh,
but
yes,
but
I guess maybe you would. So haircut.
you you can't get a haircut off of Amazon, right? You can't get your nails done on Amazon yet. Um, maybe somebody will invent something. We'll go back to the Flowbee, right? Just give yourself a haircut.
Yeah.
Um,
Oh,
look, there's always going to be certain businesses that survive, small businesses survive. But look, we've seen the death of retail over the years. The number of retail stores that have closed down, the number of company towns, small towns that have lost, kind of they no longer have a Walmart or a Costco or whatever else because just lack of traffic and those type of things. And again, it's and the Costco's of the worlds and the Sam Clubs of the worlds have replaced a lot of the mom and pop grocery stores, right? This
right.
is one of the interesting things with the Kroger Albertsons merger, right? That was trying to go through. These the big conglomerates, and look, same thing goes to farming, right? The family farm is pretty much no longer a thing anymore because the big mega corporation farms have taken over all the farming, right? And so we've decimated a lot of what used to be really the backbone of America, which was the mom and pop driven, retail business, the farms, the cattle ranchers, all those type of things. It's all been taken over by corporations and private equity and everything else. And look, we're suffering the consequences of it. The answer is, though, I have no idea how you go back to that. I mean, the only way to go back to that is that you and me and everybody else all have to say, I'm not going to order from Amazon anymore. I'm going to go, I'm going to walk my happy ass down the street and I'm going to go to, the local bakery, the local clothing store, the local, whatever it is. And I'm going to shop there. I'm going to shop local and I'm going to support my local businesses and I'm not going to order online. We could change it. We have all the power in the world to change it. But as consumers, we're lazy. We like the convenience. And so Amazon's going to continue to thrive. And I'm not sure what the long-term fate of the retail mom and pop shop is, but it certainly isn't favorable.
Yeah, and that's where I was going with this, and maybe this is its own rant to do properly someday. But the spirit of the question was, you know, it, what does this mean for society, and is it a net good or a net bad? And it seems like you think like I do. It's definitely a net bad. This is not an ebb and flow, business cycle where tough times for mom and pops, then they come raging back. This is more like a one-way ticket downhill, in my opinion.
Kind of idiocracy in real life, right?
Yeah, yeah, and even I mean, it's less an idiocracy, although I totally get the reference there, but it's just more of a corporatocracy, right? Where it's just, um, we are letting the mega corps amass a tremendous amount of value here, and yeah, you can say, hey, there's definitely some consumer benefits that come from that, but are they worth the trade-offs? And again, maybe that's a bigger rant we do at some point in time.
Yeah.
All right, so it is the last weekly market recap of 2024. So first off, Lance, I wish you and your family a happy new year, and same to everybody watching here. As you look back on the year, people love to hear things like, best calls, worst calls of 2024, that type of stuff. And feel free to share any of that. But as you look back on the year, what are you going to take away from it going into 2024, 2025?
Yeah, no. So real quick, best calls last year were NVIDIA and GE Vernova by a long shot. Worst call was CBS. Lost my ass on that one twice. I'm still convinced that stock's going to come back someday because it's super cheap. You look at the valuations; it's just an amazing money printing machine. They grow earnings every year, just super cheap. But
that's your prodigal son. You're going to bring that back into the. You're still going to bring that back into the portfolio at some point.
It's going to be it's just going to be my gravestone, right? Just you wouldn't give up on it. But look, those are investing lessons that that you have to relearn. In fact, I'm about to, at the beginning of every year, I post a series of articles about investing lessons and investing resolutions and those type of things. So those will be coming up on the website. We'll have those to discuss here on the show once we get to the new year. But every year I have to remind myself of the rules because we all get, involved in stuff and we let our emotions take over and we make mistakes. So, those are always, kind of, things. But I think the biggest takeaway from, look, first of all, managing money this year was so easy because everything just kind of went up, and it made managing money for clients very easy. Clients are happy. We had very nice returns this year, well above target rates. So that's great. The lesson that I think we have to take away from that is that we need to be thinking about a little bit of caution going into next year, because low volatility begets high volatility. And we've had 2 years of very low volatility returns in the markets. We haven't had big corrections. We've had little 5% sell-offs. We had an 8.5 in August. Low periods of low volatility beget periods of high volatility. 2021 got us 2022. I think there's a real possibility next year that we're going to see a 10 to 15%, maybe even a 20% correction sometime by the end of summer. Again, don't know. We'll be certainly navigating, but I think it's something we definitely have to put on our radar from next year because of simply the fact this market's just been in a consistent grind now for 2 years higher. And at some point, all the people that are going to buy stocks have bought. And the question is have we reached that point yet?
Yeah, you were reminding me, I just made a note while you were talking to get Jim Carson back on the channel. He is Mr. Volatility. I think basically we're seeing what he called when I interviewed him back in like September, it has come to pass more or less this year, where he said volatility will likely increase a bit going into the end of the year, but that doesn't necessarily mean lower prices. But he was then saying, I think volatility could then go even higher in 2025 and start causing some real problems. So folks, I will get an update on that outlook from him. All right, Lance, we'll look. Oh, go ahead.
I agree with that. I think he's probably going to be right on that issue.
Okay. Trades. I'm sure the market hasn't been open that much since we last talked, but have you guys made any trades yet or planning on making any in the near term?
I can't remember it last week. I think we talked about, we did take on we added to some of our energy positions, and I'll just show you a chart here real quick.
You added to your energy positions and you were thinking about what to do with healthcare.
Yeah. So energy is just super oversold. This is kind of the interesting story of the market too, is that, really if you start looking at any sector of the market, certainly if you exclude tech and communications and discretionary, which is basically discretionary is Amazon and Tesla, communications is Google and Meta, and tech is NVIDIA, Microsoft, and Apple. Strip those top 10 companies out. The rest of the market, finance, healthcare, staples, they all kind of look like crap. If you kind of look at healthcare and energy, you're like, man, this market really just fell apart this year because the participation, we were talking about breadth earlier. Breadth in the market has been very narrow. We've actually, the number of stocks trading above 50-day moving average, 200-day moving average have been deteriorating pretty rapidly, and we're kind of seeing this across sectors. And energy is deeply, deeply oversold. And I think there's a tradable bounce here. So we added we have some energy in our portfolio. We added to it because we had taken profits back in August. So we just added back those positions. And I think we'll see a little bit of a bounce maybe at the beginning of the year. We'll see what happens. People get excited over, deregulation of the oil industry, whatever. Maybe we get a bounce in oil. But we're watching that very closely. Again, just from an oversold tradable position, I think there's an opportunity there. The only trade we made this past week was in the dividend equity model. And I sold Con Ed, which is a utility stock. We were overweight utilities in the dividend equity model because of the idea about AI build out infrastructure, and Edison was the worst performer of the three that we owned. So we owned AEP, Duke Energy, and Edison. And so we sold Edison and we bought KMI for the whole same reason about energy being oversold, looking for a tradable bounce. And so we added Kinder Morgan. It's also a pipeline company, so it also benefits from the energy build out for AI infrastructure. And has about a 4.5% yield. So we took a 3% yielding stock, took it to 4% yielding stock, and just made that swap in the dividend model. So it brought our overall yield in the portfolio up a bit.
Okay. All right. Well, congratulations. All right. Well, look. Pardon? It has to be.
No congratulations until it works.
All right. Well, look, Lance, thanks so much for taking time during your winter holidays to do this weekly market recap with us. I know you and your family are taking off as soon as we end up here. And as I said, I'm kind of on fumes, so we'll start wrapping it up. I had some topics that I was excited to talk about with you in our usual sort of rant life advice here at the very end. I'm going to pivot and just mention one article real quick. An article I saw this week about a hospice nurse who's worked in the industry for decades. And she basically is just sharing the number one thing that she hears people say when they're in hospice, beginning the dying process. And first, I just want to say, I think we've acknowledged this a couple of times on this channel. People who work in the hospice industry are just wired different than the rest of us. I mean, these people are
they're saints.
They're living saints. Yeah, they really, thank God we have these people. And many folks remember my mom passed away a little over a year ago, and she did so in hospice. And it was just the absolute best experience, something that sad could have had. So I owe a big personal debt to the hospice industry. But what this woman said, and it's timely for both the holidays and for me specifically. So yeah, she's seen 100 people die, and everyone always says the same thing on their deathbed. And it's this, the main people say that I don't hear a lot of people mention is, I wish I would have appreciated my health. And this isn't just the importance of health. And you and I talk about the importance of health, right? And our whole model here at Thoughtful Money, real health, true health is relationships and purpose and health. She's just talking about the appreciation of health, like just saying, I'm mobile today, like I can walk and my knees, aren't hurting so much that I need a cane or a walker, right? I'm not on some sort of chemo program that's making me nauseated all the time. All these things that once you lose it, you realize how unbelievably priceless it is, right? And I'm even getting a tiny taste of that right now, of just, when you're this nauseated all the time, you're like, wow, a regular day feels great compared to this right now, right? So my encouragement to everybody watching is, reflect after you log off this video, especially if you're still surrounded by family right now during the holidays, and just go through sort of the active gratitude process of just like, hey, what are the simple things in my life that I probably take for granted most days that I should just take a beat, savor, smell the roses. Hopefully I've still got a lot of great, good years, decades left on this earth. But let me just acknowledge the fact that if I didn't have X, Y, or Z, life would suck an awful lot more than it does now. You're nodding as I'm saying this, Lance.
No. Look, I've talked about, exercising and working out and, eating right and being healthy, because again, what people don't realize, most people, is the cost when they get into retirement. And, we talk about retirement being the golden years. We all have, when you watch television, it's, some like, Prudential Financial commercial or, Fidelity, whatever, and shows an old couple, they're sitting on the beach holding hands and enjoying the sunset in their golden years. And that's how we picture, retirement. Reality is for most people, I shouldn't say most people because I don't know that number, but for a lot of people in retirement, they're spending a lot of time in the doctor's office. They don't feel well. They're not mobile because they haven't taken care of themselves. They're extremely overweight, and they're kind of just miserable in a lot of cases. And that's not the way we want to spend in retirement. But I saw this really great graphic the other day, and I sent it to all my kids because I'm constantly on them about eating right and exercising and doing financially the right things to do. It says you can struggle now and enjoy life later, or you can enjoy life now and struggle later. And there's just two different arcs, right? And it really just kind of honed in that, we always put off till tomorrow. Okay, and this time of the year. Do you know that the second Friday of January is called Quitter's Day? I did not know this.
No, but I'm guessing that's when everybody doesn't go back to the gym after the first week at the gym, right?
It's where they quit their resolutions for the year. They make it 2 weeks on average, right? So it's actually called Quitter's Day. I learned this today. But this is that time of the year where we all make our resolutions. Hey, we're going to do this, and the problem with resolutions are always this: they're too big. I'm going to go to the gym and I'm going to lose 50 pounds this year, or I'm going to do this. I'm going to go vegan this year. Whatever it is, it's too big. You can't do it, and you're going to do it for 1 or 2 weeks, and you're going to quit because you're going to try to jump into this thing feet first, and you're going to burn yourself out in 2 weeks and go back to doing what you were doing before because life gets in the way. Don't make those kind of resolutions. Make resolutions that are very small and attainable, so that your resolution is, in the month of January, I'm going to lose 4 pounds, right? It's very reasonable. All I have to do is slightly change my diet, increase my protein intake to 40% of my overall intake or 30% of my intake, get my carbohydrates to 30% of my intake, and make sure that fat is less than 20% of my intake. You do that, you're going to lose weight just by changing your diet, just that small fraction, right? Cut back on sodium because you don't want to die of a heart attack. Small changes. And if you make really small changes and allow your body the 21 days for those things to become a habit, then you take on the next challenge. And so your resolution shouldn't be a big year challenge. It should be a week challenge, a month challenge, things that you can attain. Because if you can do that for a week, at the end of the week, you go, I reached my goal. And now you can set a new goal and the next goal for next week and the week after that. And all of a sudden you become this habit of making small goals and achieving those goals and moving up. And then over time, once it becomes a habit, it just becomes part of your life. And this was one of the big things I learned about eating, which was I got to a health coach many years ago, and he got me into and he's the one that taught me about making better bad choices, right? And just, order a hamburger, great, just get it without cheese and mayo, right? And it sounds terrible, right? But you get used to it after a while, and then all of a sudden, when your body's used to it, it's like, that's the only way I like it. Then you get it with cheese and mayo the next time, you're like, man, it's just too much grease. It
Right.
doesn't.
Yeah.
And so let these things become part of your lifestyle, and then it's no longer a diet, right? It's just the way you eat. And
It's a habit. Yeah.
yeah, it's just the way I eat today is because it's just now part of my lifestyle. It's not a diet anymore. My exercise program, it's not working out anymore. It's just part of my daily routine. And I have it on my calendar. I have a block on my calendar that says, this time I'm in the gym, don't bug me. Turn my phone off, I go to the gym. But just if you can make these small things just become your lifestyle, it's no longer the challenge. It's always the hardest part of doing anything and building health and building structure is that initial 21 days. If you can get past that, if you can just get through that 21 days, it gets pretty easy after that.
So for folks that are feeling motivated to act on what Lance is talking about here, but maybe want some help, I'd highly recommend either reading the book Atomic Habits by James Clear,
Very good.
or go on YouTube and search him up and listen to some of his interviews and stuff, because it's all about that. He picks Atomic Habits because it's the smallest smallest thing you can start with, right? And it's all about just getting positive momentum on the small stuff and then over time accreting. No, absolutely. And just I want to wrap on this, which is, she mentioned health, but I would say, again, like anything that if you're being honest with yourself, your life would be much less rich without, um, take a moment to identify that and maybe even ask yourself, okay, great. What can I do in 2025 to either appreciate the stuff even more or bake more of this into my life? So if I'm finding that I'm really grateful for the health I have, the lack of illness, great. What are some things I could do fitness wise to even, lower my chances of getting sick next year, right? Or socially, I love the fact I've got family around me and I'm not isolated and alone and lonely, right? Okay, great. Well, how can I make sure that continues into next year? And maybe what are some things I can do with my charitable hours in the year to try to help alleviate the pain that someone else is going through on any one of these other things, right? So, anyways, good things to think about as we head into the next year. One resolution that I will share, I mentioned the other week that one of my priorities for 2025 is releasing some new content on this channel. One of the ones that's going to start the soonest is going to be, I think this will hopefully please a lot of people. Stephanie Pomboy is going to start her own biweekly appearances on this channel. So she will dial through the latest on what she sees, through her research that she does at Macro Mavens, and then she'll take live questions from the audience. And so we're something she was excited to do. I've been trying to get Stephanie to come on this channel on a regular basis for a long, long time. So I'm completely thrilled about this. And we're going to do a trial period for, I don't know, a couple of weeks, couple of months. And if all goes well, we'll make it a regular recurrence going forward. So more next week and next week's weekly market recap on the actual day it's going to launch. But it will launch somewhere by the end of the first week in January. So it'll be coming up really soon. Like I said, I know that's going to please a lot of people, just simply based on the amount of emails and comments I get on a weekly basis saying, hey, give us more Pomboy. Well, we've listened, we're making it happen. All right. Well, look, Lance, folks watching, if you think honestly, probably the most life-enhancing New Year's resolution you can make to yourself is to watch Lance Roberts every single week on this channel in 2025. Let him know that by hitting the like button and then clicking on the subscribe button below, as well as that little bell icon right next to it. We're starting a new year. We're not going to keep banging on about year-end planning because the time for that is pretty much getting thin at this point in time. But there's a lot you can do at the beginning of the new year to set yourself up for good success. Highly recommend that you work with your professional financial advisor early in the year to say, hey, what's the best strategy for me given my goals and needs, et cetera, this year. If you don't have a good one that you're already working with and would like to schedule a free consultation with one of the ones that appear on this channel weekly with me, maybe even Lance and his team there at RAA, just go fill out the short form at thoughtfulmoney.com, and these guys will be right in touch with you right afterwards. Oh, by the way, when you're there at thoughtfulmoney.com, don't forget to hit the newsletter link at the top of the page to sign up for our free Substack. And this is very, very important. If you have not yet signed up for the premium version of our newsletter, but have been thinking about it, do it now, literally, right when you get off this video, because the price is increasing to $19 a month on January 1st. And so if you sign up now, you'll get grandfathered in at the current $15 a month price, and you will continue to be grandfathered in at that low price for as long as you remain a subscriber. And just a reminder for those of you that signed up last year at the $8 a month price, you're grandfathered in on that. So we want to make sure everybody gets grandfathered in on the absolute best plan that they can. All right, Lance, my friend, again, super happy New Year to you and your family. And thanks for another great week. Thanks for carrying me this week. I really appreciate it.
No
But I'll
problem.
give you the last word as usual.
No. So, look, I just want to wish everybody a very happy New Year. Be safe, and I hope everybody has a very prosperous New Year. And let's see what we can do to make that happen.
All right, my friend. Take care, everybody else. Thanks so much for watching.